Well, let's focus on the insurance space now, and this is an exclusive that our colleague Yash Jain picked up and broke on Friday. Now, he picked up from sources that the regulator, that is IRDA, has proposed to set growth targets for insurance companies. Basically, it's asking life insurers, and this is very much with regards to life insurance companies, putting specific companies to grow their gross premiums by this and this amount. To assess the likely implications of such a move, we are now joined by Nilesh Sathe, former member of IRDAI, Jigar Mistry, co-founder at Buoyant Capital, and Swami Saran Sharma, who's founder at insuringindia.com. Gentlemen, great to have all of you here. Thank you very much.
We have Jigar Mistry also joining us now. Jigar, good morning. You know, the issue here is that till about 1 year back, when we were having that rally in insurance, and these targets wouldn't have looked unreasonable, right, for an underpenetrated market like ours. But you know, for listed stocks, what's your view now?
Yes, Anuj, good morning. So I think, these numbers, etc., need to be set in the context at which we are looking at this, right? 2.5%, 3% penetration. US is much higher, China is much higher, and left to sort of public in general, we know that the Indian people, despite insurance being a great product, are not really diverting a large part of savings into that product as much as it should go. So I think this is not just the insurer is not just, or the EAI, IRDAI is not just doing it on the basis of whims and fancies. You go on YouTube, they've uploaded a 6-hour meeting, completely being transparent on what is sort of transpiring. And also, they are making changes. So they are going ahead and asking, what do you want? The industry says, we want use and file. You want to lay the policy, issue the product first, and then, not wait for you to approve for 9-10 months and then launch the product. So that has been granted. The second demand going forward would be risk-based capital, implement Ind AS. And I think as far as they are open to suggestions, I don't think there is going to be a problem with them setting numbers. Setting numbers does help set a base. I think, skin in the game is also a great example. We have been very long proponents that, your end results must be tied in. I doubt if growth will be the only number because, like banks, you can grow very fast, but the fastest growing banks today don't have the highest, price to book multiple. So obviously investors and end users and managers' interests need to be aligned. So instead of growth, there could be some other metric that could eventually take shape if you are talking about compensation. But I think all these are steps absolutely in the right direction. We can't be hovering around 2.5%, 3% with a product that is as good. Coming to the market implication, I think it's going to have a decent impact. The regulator also focusing on the D part of the IRDAI is going to help the industry grow. They're willing to listen, they're willing to implement what seems reasonable, and therefore it will align the companies to achieve the longer growth. If this is sort of set up in line with the RBC, the risk-based capital requirements, which will free up a lot of capital, then the new age GI companies, especially something like an HDFC Life will also be depleting its solvency ratios, will see a reasonably good spurt. But I would sort of see this as a wholehearted, welcome measure. Crises can be ironed out at a later point, but this is far too important a sector to just be dead on it.
No, I mean, point taken. So mostly all of you are in favor of what is being done. I mean, of course, Mr. Sharma said there are other ways to do it, better ways to achieve it. And you're right, Jigar, that the regulator has announced a series of measures, proposals, etc., which, I mean, at least we reported at least 8-10 of these over the last 3 months, 4 months to ease the pace at which insurance products are sold, etc. My question is simply this, Jigar. So targets are 30%, between 30 and I think 50, 60% in some cases, right? If these growths were achievable, companies would do it, right? Companies are sort of do business, make money, and achieve growth, but profitable growth. The fact that they are growing it where they are growing, it's not as if they want to grow slower. Penetration is a byproduct of all of this. So just your thoughts. I mean, will they have to go into? I mean, if these targets become very important to achieve for whatever reason, in terms of if it's tied into compensation and other things, would they have to go into unprofitable products, areas which they would not normally go into, and what are the implications for stocks then? Briefly, Jigar.
Yeah, Prashant. So I think there is always this trade-off, right? Every time we have a regulation, by an agency dictating something for you to do, then people will find out a way in which to do it, which doesn't really make sense for the end shareholders, and therefore the markets won't reward them. As far as Satya sir said, this is going to be a guideline in that, the government and the IRDAI is essentially saying that, look, we mean business. We are here to listen to what you want to grow, and then you run at your maximum potential capital or maximum potential rate. So I don't doubt this will be sort of a draconian measure that if you don't achieve this, then you are going to go to jail or something. I think there will be a lot. Looking at what has transpired so far, the transparency, the openness with which this new regime is taking on, I think we need to give them the benefit of doubt before jumping to an adverse conclusion. So I'm willing to wait it out and see the final fine print of the document.
Sure, got it. Gentlemen, thanks a lot for joining us. Running a bit out of time, but thanks a lot for